Chapter 2 of our book introduces us to Dr. Landry and the Family Health Care Professional Corporation and recorded the first month's transactions using the integrated financial statement system. Let's use those same transactions to polish up our skills on debits and credits as explained in Appendix 1 of our books. So, building blocks of accounting are journal entries. That's how we record things in the real world. Debit means left, credit means right. Assets increase with debits. Liabilities and owner's equity accounts increase with credits. So Dr. Landry deposits $6,000 in a bank account for his new corporation and buys some shares of stock. So from the corporation's point of view, its cash is going up. Cash is an asset. Assets increase with debits, so we debit cash for $6,000. Capital stock goes up by $6,000. Capital stock is an equity account. It's on the right-hand side of the balance sheet, so it makes sense that it would increase with credits. Notice how we write the debits first, we write the credits second, we indent a little bit. Debit means left, credit means right, and we use account titles here. And if we want to tell a story, we use the memo line for that. Transaction B, the company borrows $10,000. So cash is going up. Just like the last example, cash is an asset. Assets increase with debits, so we debit cash for $10,000. This time we're crediting a liability account because we owe the money back. So we're going to credit notes payable. Healthcare buys land for $12,000. Land is an asset. Assets increase with debits, so we're going to debit the asset account land for $12,000. We're paying for it with cash, so we credit cash. If assets increase with debits, it makes sense that they would decrease with credits. During the first month of operations, Family Health earned patient fees of $5,500, receiving the payment in cash. Cash is an asset. Assets increase with debits, so we debit cash for $5,500. We credit our revenue account. In this case, the revenue account is called fees earned. So our revenue account keeps track of our earnings, whether we get paid today, tomorrow, or never. The way that I like to remember that the revenue account increases with credits is expense or debits, expense or debits, expense or debits. The opposite of expenses is revenue, so a revenue account must increase with credits. Two final transactions in September for Family Healthcare. They pay their bills. So let's pretend like we write one check for all these bills. Expense or debits, expense or debits, expense or debits. So we're debiting these expense accounts, and we're pretending like we write one big check for it, so we credit cash for $2,900. Notice how the amount of our debits always equals the amount of our credits. And then finally, Family Healthcare pays $1,500 in dividends to Dr. Lee, the stockholder. I say dividends look like expenses, but they aren't. In other words, they're also recorded with debits just like expenses. But expenses are spent on the business to increase sales. Dividends simply return property to the shareholders. In this case, it returns cash. Cash decreases with credits. So we credit cash for $1,500 while we debit dividends for $1,500. And once we get all our transactions recorded via journal entry, we post them to their accounts, and we can strike balances as to how much cash we have, how much land we have, what our wages expense has been this month, etc. So hopefully you can review this video and get a good handle on expenses and revenue and assets and liabilities and how to record them using debits and credits.